Good morning, everyone. Welcome and thank you for joining us in today's webinar. If there's one key message from MAS today, it is this. Climate risk is no longer a sustainability issue. It is a financial risk and a strategic priority. In this session, our speaker will walk you through what that means in practice and how it impacts corporates, banks, and asset managers. Now, before I introduce our speaker for today, I'd like to briefly share some information about our company, InCorp Singapore. We are the leading one-stop corporate solutions provider and business advisory group in the Asia-Pacific region for company incorporation, corporate secretarial support, taxation, accounting, compliance, ESG, risk assurance, and other services. For more information, visit our website at www.incorp.asia. Now, just a few housekeeping notes before we get started. Today's webinar session will last around 25 to 30 minutes. If you have any questions, please submit them in the post-webinar survey that will appear on your browser when this session ends, or via the survey link in the follow-up email. Now, in the event of any technical issue during the session, we seek your kind understanding and please bear with us while we rectify the issue. Today's presentation slides can also be shared with you upon request, so please indicate this on the survey form that we'll share after this webinar. Now, let me quickly introduce to you our esteemed speaker for today, Ms. Tina Thomas. Tina leads our ESG and sustainability advisory at InCorp Singapore. She has spent over 15 years working across carbon-intensive sectors, focusing on climate strategy, ESG integration, and regulatory compliance. Her work today involves advising corporates and financial institutions on frameworks such as the ISSB and MAS guidelines, as well as transition planning. From an academic perspective, she has recently completed her PhD, in which she focused on how organizations respond strategically to climate change and the energy transition. She also holds an MBA from London Business School, econometrics from LSE, and an engineering degree from IIT. Lastly, Tina is also a recognized regular speaker at SID events and training sessions, a researcher and educator in sustainability and corporate strategy, committed to guiding organizations through the transition to a low carbon, resilient future with practical insights and strategic clarity. Now, without further ado, let's welcome Tina. Hi, Tina. Please take it away.
Thanks for the introduction, Camille. Now we'll delve into the MAS updates. This slide sets the foundation for understanding the MAS transition planning guidelines to 2026 and what transition planning really means in practice. Starting with the definition, transition planning is essentially about embedding climate considerations into internal risk management and strategic planning. It's not a separate exercise, but something that sits at the core of how an organization prepares for climate-related risk and potential shifts in the business model. The objective is very clear. It's about building resilience across multiple future scenarios. These scenarios could include physical risks, such as extreme weather events, but also transition risks, such as changes in regulation, technology, or even consumer preferences. And more importantly, the output of the process is a transition plan, which can either remain internal or be externally disclosed, depending on the organization's strategy and regulatory expectations. Now, placing this within the regulatory context and timeline, MAS issued these guidelines in March 2026, an extension of the earlier 2020 Environmental Risk Management Guidelines. What we're seeing is a clear evolution from risk management to structured transition planning. The expectations apply broadly across banks, insurers, and asset managers, with a transition period leading to a full implementation by September 2027. On the right-hand side, the slide highlights some of the key shifts from 2026 to 2020 to 2026. First, there was a strong emphasis on structured customer engagement. Institutions are now expected to go beyond basic conversations and develop formal processes to assess and respond to clients' climate risks. Second, MAS is pushing for a risk-proportionate approach, meaning that transition planning should be tailored based on size, nature, and risk profile of the institution, recognizing that SME and large corporates require different approaches. Third, there is an explicit recognition of data limitations through the concept of proxy data governance. Institutions must ensure proper documentation of assumptions and methodologies when using estimates or proxies. Fourth, MAS is very clear that there should not be any indiscriminate divestment. Instead of withdrawing credit abruptly, banks are expected to engage clients in a structured and managed transition. Fifth, there was a significant shift toward financial integration, where outputs from the scenario analysis and stress testing now must feed directly into the capital adequacy frameworks. And finally, there is a strong push for internal alignment, with senior management expected to link climate strategies directly to performance measurement and decision making. Overall, what the slide shows is that transition planning is moving from a conceptual, disclosure-driven exercise to a deeply embedded, financially integrated, and operationally driven framework. This slide places MAS transition planning guidelines within the global regulatory context. And the key message here is that Singapore is not alone, but it is leading in terms of clarity and structure. Starting with Singapore, MAS is one of the few regulators that has introduced a dedicated transition planning framework, explicitly requiring institutions to establish structured transition planning process and to engage customers in a forward-looking, risk-proportionate manner. This is important because it formalizes transition planning as a core supervisory expectation, not just a best practice. If we look into the euro area, the approach is slightly different. The European Central Bank does not have a formally labeled transition plan requirement, but it's clearly emerging in substance. Banks are expected to integrate climate risk into the strategy, business model, and capital adequacy processes. And from 2026 onwards, the ECB will begin assessing transition plans as part of prudential supervision. In the UK, the Prudential Regulation Authority has also taken a strong stance. While it does not explicitly label this as transition planning, the expectation is that firms embed climate risk into strategy and risk appetite, and importantly, by 2026 June, institutions must be able to demonstrate compliance through internal reviews. So again, we see transition planning embedded, but not just explicitly branded. Looking at Hong Kong, the focus is on integrating climate and transition risk into overall business strategy, supported by scenario analysis and stress testing. This reflects a more risk-based approach, but still aligned with the broader transition planning agenda. And finally, in Malaysia, Bank Negara has taken a comprehensive approach through the CRMSA framework. We see strong emphasis on governance, strategy, risk management, and scenario analysis alongside ISSB aligned disclosures and the use of taxonomies and implementation plans. While not labeled as transition planning, the components are clearly aligned. So stepping back, the key takeaway is this. Globally, regulators are converging on on the same underlying expectations, integrating climate risk into strategy, risk management, and financial decision making. However, MAS stands out because it has explicitly formalized this into structured transition planning framework, making expectations clearer and more actionable for institutions. Now let's look at how these directives impact corporates, asset managers, and banks. This slide is critical because it explains how MAS transition planning guidelines, although directed at financial institutions, directly cascade into corporates. In effect, banks become the enforcement mechanism, translating regulatory expectations into real economic impact. Let me walk through four key implications. First, we see escalated data and disclosure demands. Financial institutions are now required to collect granular climate-related risk data to inform their decisions. This means corporates must be ready to provide Scope 1, Scope 2, and Scope 3 emissions, physical and transition risk assessments, asset-level data, and even supply chain vulnerabilities, including how carbon costs may pass through the value chain. So the shift is from high-level disclosures to decision-grade auditable data. Second, there will be intensified scrutiny on a long-term business viability. Banks are no longer focused on short-term financials. They are now assessing whether a company's business model is resilient under future transition pathways. This includes evaluating stranded asset risk and closely examining CapEx plans for transition or adaptation. In other words, strategy and capital allocation are now under climate scrutiny. Third, this is a direct impact on financing assets and cost of capital. Banks will adopt a differentiated portfolio approach, meaning companies that are less prepared for transition might face higher and tighter credit conditions or higher cost of capital. On the other hand, corporates that are proactive can access transition financing solutions such as blended finance or funding for early asset retirement. So transition readiness becomes a financial differentiator. And finally, this does not translate into banks simply existing relationship. MAS is very clear on no indiscriminate divestment. Instead, what we see is a sustained multi-year engagement between banks and corporates. This means ongoing monitoring, structured engagement, and support for risk mitigation and transition progress over time. So stepping back, the key message is transition planning is no longer just a regulatory or reporting requirement. It becomes a core determinant of capital access, business viability, and long-term competitiveness. So what should corporates do? At the core, the shift is from reactive disclosure to a proactive strategy and execution. The first priority is embedding climate into core strategy. This means climate considerations cannot sit within sustainable teams alone. They must be integrated into business strategy, capital allocation, and long-term planning. Companies need to strongly articulate how their business model remains viable under these different transition scenarios. Second, there is a strong need to strengthen data and analytical capabilities. As banks demand more granular information, corporates must build the ability to generate reliable, decision-useful data, including emissions, risk exposures, and scenario analysis outputs. This is no longer about reporting, it is about decision-grade data infrastructure. Third, organizations must develop credible transition pathways. This includes setting clear targets, defining interim milestones, and aligning CapEx and operational plans to those targets. Importantly, companies must be able to demonstrate how they will be transitioning, not just what they aspire to achieve. Fourth, there is an increasing focus on governance and accountability. Boards and senior management are expected to oversee transition planning with clear ownership, monitoring mechanisms, and performance linkage. Climate is now becoming a part of how performance is evaluated internally. And finally, companies must be prepared to demonstrate long-term resilience and viability. This is what banks and investors ultimately care about, whether the business can sustain performance in a transition economy. So the key message is this. Transition planning is no longer an external requirement. It is becoming a core capability that defines on how companies compete, access capital, and survive over the long term. This slide outlines the key new requirements for asset managers under the MAS transition planning guidelines. And what we are seeing is a shift from high-level ESG integration to deep decision-driven portfolio management. Let me walk through this in a structured way. First, governance and strategy. Boards and senior management are now expected to explicitly integrate climate-related risk into business strategy, risk appetite, and portfolio allocation decisions. This means climate is no longer just a reporting overlay, but it also helps to shape how capital is deployed. Second, MAS is emphasizing a sector-specific approach. Asset managers cannot treat all sectors equally. They must differentiate their approach based on sectorial risk, particularly for high-emitting or transition-exposed industries. So portfolio construction becomes a granular and more risk-sensitive. Third, there is a strong push towards forward-looking tools. Asset managers are required to use tools such as climate scenario analysis to identify and quantify risk across the asset classes. This is critical because climate risk is inherently forward-looking and not backward-looking. Fourth, on data and metrics management. MAS acknowledges that data is imperfect, but asset managers must recognize the limitations of proxy data, clearly document assumptions, and select appropriate metrics to track portfolio exposures. So again, it's not about perfect data, but about defensible and governed data. Fifth, there is a new requirement for target evaluation. Asset managers must assess how portfolio targets, or even the absence of targets, impact the overall risk profile and business strategy. This introduces accountability around whether targets are meaningful and aligned to risk. Sixth, MAS expects vulnerability prioritization. Engagement efforts should be focused on investee companies that are most exposed to climate risk. So stewardship must come from more directed and targeted and impact-driven. Seventh, there is a clear expectation for risk proportionate engagement. Engagement with investee companies should be structured, multi-year, and aligned to the level of risk, including how data is collected and monitored over time. And finally, MAS is very explicit on avoiding indiscriminate divestment. Asset managers should not simply exit high-risk sectors. Instead, they are expected to support companies through the transition to avoid a disorderly transition in the real economy. So what should asset managers actually do next? First, asset managers need to revisit the risk. This means reassessing your climate risk and opportunities across your portfolios, not just in a point of time, but across multi-year lens supported by forward-looking scenario analysis. So the focus shifts from just a static risk assessment to dynamic, forward-looking risk understanding. Second, they need to clarify the strategy and strengthen the governance. At the enterprise level, this involves defining a clear climate ambition, reinforcing board oversight, and building a robust data architectures to support decision making. In other words, climate needs to be embedded into how organization is governed and managed. Third, asset managers must develop a transition blueprint. This is where climate considerations are operationalized, embedded into portfolio strategies, client engagement models, and core risk processes. So strategy moves into execution. Fourth, they also need to prepare disclosures. This means aligning with international frameworks such as TCFD, ISSB, and being ready for transition plan reporting that is transparent, consistent, and decision useful. The final update on the banks, the elevation of governance as a foundation of transition planning. At the core, MAS is very clear that climate risk is no longer a technical or a sustainability issue. It is a board level responsibility. First, decisions made by the board and senior management, particularly around business strategy and risk appetite, must explicitly incorporate climate-related risk. This means climate considerations must be embedded into the core decision making, not just treated as a separate overlay. Second, senior management is expected to ensure that climate-related business strategies are operationalized. This includes establishing clear processes, controls, and accountability structures to translate strategy into execution. Third, there is a strong emphasis on policies, procedures, and internal frameworks. Institutions must put in place formalized governance structures that define on how climate risks are identified, assessed, monitored, and managed across the organization. And importantly, governance is not static. It must be supported by an ongoing oversight, monitoring, and review mechanisms to ensure that climate considerations remain integrated as conditions evolve. So what should banks do? Well, very similar to asset managers at a high level, this is about moving from risk awareness to integrated financial decision making. First, banks need to revisit this. This means reassessing climate risk and opportunities across lending and investment portfolios using a multi-year horizon supported by scenario analysis and stress testing. Importantly, this is about understanding how climate risk translates to credit risk, market risk, and concentration risk. Second, banks must clarify strategy and strengthen governance. This involves defining clear enterprise-level climate ambition, reinforcing board oversight, and ensuring that data, architecture, and risk systems are robust to support climate-informed decisions. So climate becomes embedded into risk appetite frameworks and strategic planning. Third, banks need to develop a transition blueprint. This is where strategy is operationalized, embedding climate considerations into portfolio steering, sector limits, client engagement models, and credit processes. In other words, climate risk becomes part of how lending decisions are made. Fourth, banks must prepare for disclosures. This includes aligning with frameworks such as TCFD and ISSB and preparing for transition plan disclosures that are consistent, transparent, and increasingly scrutinized by regulators and investors. And this is my final slide. This slide provides an overview of our end-to-end ESG and climate service offering designed to support corporates, financial institutions, and asset managers across a full transition journey. We structure services into three broad key areas. First, mandatory reporting and assurance. We support organizations in preparing ISSB-aligned disclosures, ensuring that they are investor grade and globally aligned. We also help build assurance readiness, including strengthening data, controls and documentation, and conduct TCFD-aligned disclosure scenario analysis to quantify risk under different future pathways. Second, we also look into ratings and investor relations. We work with clients to improve the ESG ratings across platforms such as MSCI, DJSI, EcoVadis, CDP through structured gap analysis and targeted action plans. We also provide recipe support for REITs and help organizations map and prioritize Scope 3 emissions across supply chains, which is increasingly becoming critical for investor transparency. Third, decarbonization strategy. We help clients develop net zero roadmaps aligned with science-based targets, ensuring alignment with business strategy. This includes designing internal carbon pricing mechanisms to embed carbon into decision making and developing green financing frameworks such as green bonds and sustainability-linked loans to support access to capital. This is the end of the presentation now. Over to you, Camille.
Okay, thank you so much, Tina, for sharing today. And to all the participants in this session, thank you for joining us, and we hope you found this webinar informative. Now, before we end this session, I'd like to invite everyone to join Tina's next webinar, this time with SID. If you want to learn more about how the ESG landscape is evolving, you can join this webinar, during which she will deliver a brief presentation followed by a panel discussion that she will also moderate with fellow panelists, OCBC's chief economist, the deputy head of Asia Equity at Amova Asset Management, and a co-lead of the ESG chapter at the Singapore Corporate Council Association. So to register, you can just scan the QR code here, and the webinar will be on the 30th of April from 2 p.m. to 4 p.m. Now, once again, if you have any questions or want to request a copy of Tina's slides today, please submit them via the survey form, which will appear in your browser after this webinar ends, or via the survey link in the follow-up email. If you want more information on our service offerings, please visit our website at www.incorp.asia. Lastly, to stay updated on our future ESG-related webinars, please follow or watch our space on LinkedIn for webinar announcements. We appreciate your participation and look forward to welcoming you again at our upcoming sessions. Thank you, everyone, and have a wonderful day.